So we ended our last lecture on a cliffhanger, trying to determine if the bond has a contracted rate of 10% and the market is paying 8%, will our bond be issued at a discount, face value, or a premium? If you said premium, you are correct. If we're paying 10% interest, the market is paying 10%, would a bond sell at a discount, face value, or premium? If you said face value, you are correct. If we're paying 10% interest and the market is paying 12%, would a bond be issued at a face value, premium, or discount? If you said discount, you are correct. So depending upon the current market rate at the time your bond is issued, that will determine whether your bond will sell at a premium, an amount above its face value, meaning sold at face value, or a discount, an amount below face value. All right? For example, we have Candlestick Inc. sells $100,000 5-year 10% bonds at 98. So again, when bonds are issued on the bond market, their quote will say such as at 98. 98 means 98% of the bond's face value. So this bond is selling at a discount. What does that mean? It means the current market interest rate is higher than the bond's contractual interest rate. Now, bonds are a good form of investment, but this 10% you see on this slideshow, this is an academic illustration, okay? If you're buying a bond in 2020, you're not going to get a 10% return on your investment. Probably somewhere between 3 to 2%, maybe 4, depending upon the type of bond. Okay? Sorry. All right. Now, again, this bond sold at 98, meaning it sold at a price below its face value, which says it was issued at a discount. This will be the journal entry made by the Candlestick Incorporation. They would debit cash $98,000 because it was issued at 98%, 98% of $100,000, $98,000. They recognize an account title called Discount on Bonds Payable, which is a contra liability account, and they're going to credit bonds payable for the bond's face value of $100,000. So if the bond is issued at a price below its face value, you record into an account called Discount on Bonds Payable for the amount of the discount. A discount simply means that your bond was issued at a price below its face value because the current market interest rate is higher than the bond's contractual interest rate. All right? Now, this discount on bonds payable has to be amortized over the life of this bond. Amortize means to reduce. So this bond has a 5-year maturity period. Therefore, over the next 5 years, we're going to amortize or reduce the discount on bonds payable account. And we'll see how we're going to do that. Now, on the actual balance sheet, because the discount on bonds payable is a contra liability, it is subtracted from the bonds payable account to get what's known as the bond's carrying value. So right now, the carrying value is the same as the amount the bond actually sold for. But over the next 5 years, this discount is going to be reduced, and the carrying value is going to increase. And that's because when this bond matures 5 years later, the amount owed to the bond holder will be the $100,000 because that's the bond's face value or maturity value. Okay? So if you need to, pause the video and go back over it. But again, this discount on bonds payable is going to be amortized or reduced over the next 5 years. And as you reduce the discount on bonds payable, this amount here known as the bond's carrying value is going to increase. So by the end of the 5-year period, when this bond matures, the bond's carrying value will be the same as the bond's face value. And we'll go through examples of how to amortize the discount on bonds payable. Okay? So the actual discount again will be amortized at the end of each accounting period. As we recognize the amount of interest expense, we're going to reduce or amortize the discount. Let's get right into it, shall we? Okay. Well, I'm going to come back into it because now I have a different type of problem. I thought I had another problem showing the discount being amortized, which I do, but it's on the back end. I'll show you a bond issue at a premium first, and then we'll show you how to amortize a discount and a premium. Okay? All right. So assume that Candlestick Inc. bonds previously described sells at 102. So we're saying now, what if the bonds were issued at 102? Again, the 102 represent a percentage of the bond's face value. We're saying the bonds for $100,000 selling at 102% of their face value for a total of $102,000. If that was the case, the amount of cash received would be $102,000. You always credit bonds payable at their face value amount, which is $100,000. And the difference goes to account title called premium on bonds payable that we're going to credit in the amount of $2,000. Just like the discount, this premium has to be amortized over the life of the bond. Recall this bond has a 5-year maturity period. Therefore, the next 5 years, we're going to amortize or reduce its premium so that when that bond matures, its carrying value will be the same as the bond's face value amount. Okay? Because right now on the balance sheet, because of the premium, the bond is showing a carrying value of $102,000, which was the bond's actual sales price, and that makes sense. But over the next 5 years, this $2,000 is going to be amortized or reduced so that when the bond matures 5 years later, this amount known as a carrying value will be the same as the bond's face value. Okay? So now let me show you how we're going to amortize that discount for the bond. And where is that transaction? I'm going to come back to those. Finally, okay. So going back to our product, I'll go back to the slide. I promise I should have this in better order. I apologize for that. So going to this slideshow here, remember again that this goes back to the example when the bonds were issued for $98,000. Remember we debited cash $98,000. We had a discount on bonds payable for $2,000, and we credited bonds payable for $100,000. That was back in January. Stop it, slideshow. Now we're saying that that discount of $2,000 has to be amortized or reduced over the actual life of this bond. We do what's called straight line amortization. Straight line amortization, which means that this $2,000 will be amortized equally over the life of the bond. This bond has a 5-year maturity. Just take $2,000, divide that by 5 years. So we're going to amortize $400 each year over the next 5 years for this bond. Now recall the discount on bonds payable account has a debit normal balance. it increased on the debit side. So, in order to amortize or reduce the discount, we're going to credit the account by $400 each year over a 5-year period. All right? So, remember that the bond has a 10% interest rate. We're going to pay the bondholder interest every year based upon the contractual interest rate and the bond's face value. So we're going to owe the bondholder $10,000 each year in interest. We're going to pay them on the 1st of January. So you recognize a liability account known as interest payable that we credit for $10,000. We're going to amortize that discount by $4 each year for the next 5 years. That account is shown on the credit side to reduce the discount on bonds payable. We're going to recognize interest expense in the amount of $10,400. This would be the adjusting entry we're going to make each year over the bond's 5-year maturity period. You make the adjusting entry on December 31st each year over the next 5 years. Now, note that the interest expense is higher than the interest payable, right? Yes. And that's because, remember, this bond sold at a discount, which means that the market rate of interest was higher than the contractual rate of interest. Now, hear me out. Interest expense is based upon the market rate of interest, whereas interest payable is based upon the bond's contractual or stated rate of interest. When a bond sells at a discount, it means the market interest rate was higher than the contractual rate. Therefore, its expense will be more than the interest payable. If a bond was issued a premium, it would be just the opposite, and the expense will be less than the interest payable. Okay? So again, take your time, rewind this section of the video to make sure you understand that concept. Now, as I mentioned previously, the discount is going to be amortized or reduced over the actual life of this bond. As we reduce the discount, the carrying value is going to increase. Because when the bond matures 5 years later, the bond issuer must pay the bondholder the face value of $100,000. The carrying value at that point in time must reflect its face value. So note that the carrying value is increasing by $4 each year as we amortize this discount. So by the end of 5 years, the carrying value of the bond is the same as the bond's face value. Okay? The same holds true for a premium, the same concept. In this case, again, the premium amount was $2,000. This bond has a 5-year maturity period. So at $2,000 divided by 5 years, we're going to amortize the premium $4 each year over the next 5 years. Now the premium has a balance shown on the credit side. So to amortize or reduce the premium, you're going to debit premium bonds paid for $400. The interest payable is $10,000. The interest payable always represents the amount owed to the bondholder based upon the bond's contractual interest rate and the bond's face value. Now, the interest expense will be lower than the interest payable. That's because if a bond sold at a premium, the market rate of interest was less than the stated rate of interest shown on the actual bond contract. That premium is going to be amortized over the next 5 years so that once the bond matures, the bond's carrying value will be equal to the bond's face value.